All right, I'm going to describe a stock and then you tell me if you feel like this is an attractive opportunity or not. So this is a very disruptive company that has an extremely strong moat around it. It has a bulletproof balance sheet with more than $340 million in cash and $0 of debt on the books. This company has a gross margin near 80%. They're also already profitable with a net margin around 9%. And their profitability numbers are exploding. Year over year, their operating income was up more than 5x. Their net income was up more than 4x. Their adjusted EBITDA grew more than 250% year over year in the most recent quarter. They're growing revenue by 111%. And they just acquired a company in an all-cash deal that adds 1.3 million customers to their already existent 2.4 million customers. And this is an overseas company. It's a UK company. So this is expanding their international footprint as well. And lastly, they introduced 2030 revenue and adjusted EBITDA targets that represent more than a 3x of revenue between now and 2030 based on their goal, and more than a 7x in adjusted EBITDA between now and 2030 based on the target they released earlier this year. So having all that within one stock might sound too good to be true, but these are the actual growth rates, the actual fundamentals of a company that I've been buying for more than a year now in the market. And we're going to get into that stock in this video today. But first, if you're new here, welcome. I'm Austin. I'm a co-owner of cloudmusicsuite.com. I'm also a stock market investor. And most importantly for this video, I am a shareholder of this company. I've been buying it for over a year now. And the first time I bought the stock, it was 13 bucks. I'm still buying the stock and it is so much higher today. Now, as of recording this video, the stock is all the way up to $59.24, which means since I started buying, we're up 351%. And just over the past year, the stock is up 145%, but I think we have so much more to run. And I absolutely see this stock being at least $100 per share over the next few years. Real quick before we jump into the video, two things. One, if you're not subscribed, go ahead and do that. We're extremely close to hitting 7,000 subscribers. So click that subscribe button and help us get to that goal. And then two, consider joining us in the Patreon. The first place I talked about the stock in this video today was on the Patreon. The first place I always talk about any investment opportunity I'm looking into is on the Patreon. So if you want to be the first one to hear about stocks I'm looking into, stocks I've purchased, it's going to be way quicker for me to post that on the Patreon than it is to record a whole video and edit it and put it on YouTube. We just hit 140 members in there recently. We'd love for you to join us as well. Check it out with the link in the description and pinned comment down there. All right, let's jump into the video. So as I was going through some of those metrics and growth rates at the beginning of the video, some of you may have figured out what stock I was talking about, but for those who didn't, this is Hims and Hers Health, ticker HIMS on the market. This is a $13 billion telehealth company that helps their customers get convenient and confidential access to medications that help them with sexual health, weight loss, hair regrowth, mental health, skin health. They've also got menopause treatments coming. They've got TRT coming, testosterone replacement therapy. They've got all kinds of things coming in the pipeline. And through expanding their existing offerings and adding new product offerings, that'll help them reach their long-term goal of 100 million customers. Right now, they have 2.4 million customers. They just acquired a UK-based company called Zava that basically does the exact same things that Hims does. And to be honest, down the road, if they didn't acquire them, they probably would have turned into a competitor over time. But they went ahead and acquired them in an all-cash deal that they say is expected to close sometime in the back half of 2025 and be accretive as early as 2026. So we'll start to see the benefit of adding these 1.3 million customers that Zava has to Hims. We'll start to see it in the revenue. We'll start to see it in the EPS over 2026. That is their assumption, assuming the deal is able to close in the back half of 2025. So adding those 1.3 million customers to Hims' existing 2.4 million customers, we're at least 3.7 million customers. And that doesn't include this quarter's growth in Q2 that we're going to see whenever they report their Q2 earnings. So not only is this going to give them a nice boost in customer count, in revenue, in net income, but it also expands their footprint internationally into the UK. And by acquiring Zava, rather than going out and just expanding the Hims brand into the UK, because Hims doesn't have to go out there and jump through all the legal hoops in order to make sure that they can run their business in the UK, they can just use what Zava has already built. So I think this is a very smart move for Hims. They didn't add any debt to the balance sheet to make this deal happen. It was an all-cash deal. Now we talked talked about international expansion. We talked about margin. We talked about growth rates. Everything looks great, but let's check out the valuation to make sure that we're not getting totally ripped off. Remember, when you have over 100% revenue growth, over 300% net income growth, over 400% operating income growth, you're going to have to pay a premium for that. Also, a very disruptive, tech-focused company, you're going to have to pay a premium for that as well. So the valuation is not going to be that of a value stock. We're not going to get a PE of like 10 or 12 or 15 on this stock. So just remember that. You're paying for the growth that you're getting. So we're not only going to look at this year's PE, but we're also going to look at 1 year out, 2 year out, 3 year out, 4 year out, based on analyst estimates, okay? Forward PE for fiscal 25 is an 85.99. The 2026 forward PE is about a 60, 2027 about 46, and then 2028 roughly 32. But I've got a bone to pick here, okay? This is based on EPS growth rates of 31% for 2025. 43% for 2026, 29% for 2027, and 45% for 2028. I believe the 2025 and the 2026 EPS growth rate estimates are way too low. We just saw a 300% increase in EPS from Q1 of 2024 to Q1 of 2025. Let's be real here. The EPS growth rate on this company has been more than 2x the revenue growth of this company for so many quarters in a row now. What makes me think it's going to drop off in such a major way? The revenue growth rates over the past few quarters, 51%, 77%, 95%, and then 111%. Not only is the revenue growth rate accelerating, but also the EPS is accelerating at a crazy rate right along with it. With EPS beats 3 of the last 4 quarters, and then 1 was a meet. Over the last 4 quarters, they beat EPS by 1 cent, and then they beat EPS by 27 cents, and then they met analyst estimates, and then they beat EPS by 8 cents. The odds that they're going to beat EPS estimates for the next 4 quarters are very high. The odds that the EPS growth rate is going to outstrip the revenue growth rate for the next 3 quarters are very high. I think the 31% EPS growth rate that's expected is way too low. I think it'll be about double that at nearly 60% or higher for fiscal year 2025. Which means in actuality, the forward PEs are likely much lower than what you're seeing based on HIM's ability to beat analyst estimates pretty much every single quarter and their ability to grow their EPS at a faster clip than they've been growing their revenue. But even if the analysts are right, I'm okay with buying a stock that's trading at 60 times 2026 earnings, that's growing like HIM's is growing, that has the runway of growth in front of them like HIM's has, and that's a disruptor with an extremely strong moat and a founder leading this company. I am comfortable buying this stock at those multiples. HIM's is definitely not a deep value play right now. You've got to pay a premium for a disruptive company that's a leader in their space that has so much expansion opportunity over the next decade plus. So I am actively buying HIM shares. I don't want to look back on this stock 5 or 6 years from now and think, man, I wish I would have bought more shares of HIM's. I don't want that situation to play out, so I am still buying, even though it's way up from where we first started buying, around $13, all the way up near $60. It is what it is. You got to pay up for growth sometimes. I really like the stock under 60. I love the stock under 45. And if for whatever reason we get some major depression in the share price and we get the stock under 30, I will be buying every single share I can possibly get my hands on. That is a blessing if we can get HIM's under 30. That is a steal deal at that point, okay? When I'm acquiring shares, the lower the stock is, the better. As long as the fundamentals are intact, I welcome any fear-based drops in the short term so that I can increase my position even further, especially with a generational company like HIM's that I plan to hold for at least a decade. Let me know in the comments below if you hold HIM's shares and what your average cost is with HIM's if you do hold shares. I'm looking forward to reading those. Definitely one of my favorite parts of posting here on YouTube is having some conversation with you guys in the comments section. If you want to hear about all the other stocks I'm buying, selling, holding, consider checking out the Patreon with a link in the description and the pinned comment down there. I appreciate you being here in a major way. Thank you so much. Have a great day.